Good afternoon, everyone. It's James O'Reilly here from Northeast Wealth, and I'm here today to make sense of some of the carnage that we've seen on the share market of late. Not just how it's come to be, but what is it going to mean for you all going forward. So earlier in the week, there was a key indicator in the US which gave rise to some significant concerns about recession in the future. And I thought I might just take a moment to explain exactly what that indicator is. So it's an indicator called the 10-year to 2-year Treasury bond spread. And what that jargon means is that from the US government, you can essentially buy a term deposit where you give them the money over 2 years, they agree on the interest rate, and then they'll pay you back after 2 years. It's largely considered to be one of the safest bets that you can make because the US government is pretty well backed, unlikely to see a significant and financial collapse altogether. So there's a very high likelihood you're going to get your money back. So it's very much seen as often as sort of the risk-free rate. It's the rate of return that you can get without really taking any risk. Now there's the 2-year term deposit and there's the 10-year term deposit. And it stands to reason that if you're investing for a 10-year period, with a healthy economy, you should get a better return than if you're to invest over a 2-year period. Now, this indicator, this 10-year to 2-year spread, tracks the difference between investing for 10 years and what kind of rate you could get versus investing for 2 years and what kind of rate that you could get. And of course, the belief is that any time the 10-year goes below the 2-year, essentially what's being said is that the 2-year outlook is more positive than the 10-year outlook. And that speaks volumes about what's anticipated over the next 10 years for that economy. So far, there's been super high correlation between this figure or this indicator and a US recession. And if we're looking at this spreadsheet here or this graph here, you can see that as the rate has fallen below this red line, at this point that means that the 2 years worth more than the 10-year. These grey bars indicate US recessions. So we saw this in around 1980. We saw it again in 1983 or 1982. We saw it again in 1991. As in the recessions, of course, and you can see immediately prior, we're often seeing these figures or these numbers come down. In fact, it's accurately predicted, the 10-year to 2-year has accurately predicted the last 7 US recessions. So here we are in 2019, and we've seen again this number dip below. Given the accuracy, I think there's a very reasonable likelihood that we might be looking at a US recession in the future. So what does this mean for you if you're an investor? Well, it can mean a lot of things, but probably the most important thing to be aware of is that, of course, as you can appreciate, recessions and poor share market performance, they are correlated, without a doubt. They're very heavily correlated. So what you can see here is that this is almost 100 years of US share market data. And these blue rises are periods where we're seeing what's called bull markets, and that's success in the market, strong growth in the market over a sustained period. And the orange amounts here are what we call bear markets, and that's sustained negative growth in the share market. To give you some context, this was the Great Depression, the crash of 29 and the resulting flow. If we go more recently over here, we had the dot-com bust in this period in 2000, 2001. And over here, we had the global financial crisis in 2007. So we're looking at 100 years of data here. So I'd like you to draw your attention, if I may, to the orange bars here, because they, again, are indicative of recessions. What can we take from this? Firstly, it's clear that these orange bars and these recessions, there is a pattern here where these significant pullbacks are often related to periods of recession. But you can see, not always. It's not always the case, but largely there's a pattern. You can also see, though, that there are periods where we have recessions and that ultimately doesn't have this significant pullback. We still see, over a prolonged period, strong growth. We might see a small blip. However, the trend continues. Now, this graph is actually only until 2018. If we add 2019, it's an extra year. So we're somewhere over this sort of point because the US market has continued to grow on its merry way. Of course, wherever possible, we want to sort of avoid these periods because these are those scenarios where you do see significant pullback. If you're a client, invariably we've talked about worst case scenarios and setting expectations about in a GFC, in one of these horrible situations, here's what you can expect. And the reason that I do that is that I know that if we're investing over a really long period of time, you're going to have these periods. Well, of course, we have options when we go through that period, but nevertheless, I want to make sure that the right expectations are set. So again, if we think about this, when it comes to recessions, there is a reasonable likelihood that a recession will also carry with it significant underperformance in the US share market. And the US market represents a huge amount of the global market. Typically, when the US sneezes, everyone else catches a cold. So if we focus on these periods that I've indicated with the green arrows, and these are, of course, the periods of time when the US market, or when the 10-year to 2-year has come under, and so this is these key indicators of the recession. Bearing in mind, this is just a 30-year graph. This is no longer 100. If we put these green arrows across onto the US share market performance, you can see a trend. Firstly, it does appear that there is some correlation between poor performance, or certainly recessions, as we've already talked about, but also periods of underperformance, or alternatively, very, very poor performance. The question mark is, where exactly are we here, and what can we expect over the next few years? And that's something naturally that we're watching very, very closely. I don't have a crystal ball, but without a doubt, it is all hands on deck in terms of watching investment portfolios and making sure that you're still correctly allocated and we're making the right decisions for your portfolio. Now, I'd add one more thing, and that's that the US market, or the US recession, is also very strongly correlated with Australian recession. There have been periods over the last 40 years where Australia has had recessions and the US has not. And there have also been periods where the US has had recession and Australia has not. And the two best examples are here, the two most recent ones. We very narrowly avoided a recession in 2007, 2008 during the global financial crisis. And we also avoided a recession during this dot-com bust. A big reason for that, of course, is that Australia has always had very, very little dot-com exposure and dot-com shares. But nevertheless, US recessions don't always mean Australian recessions, but they often do. A concern that we have at the moment is that if we look at interest rates on the whole, these interest rates have continued to get pulled down, of course, trying to stimulate the economy. We're now at 1% after the two most recent rate cuts. Now, this is a problem, bluntly, and the reason that it is because A, it hasn't stimulated the economy the way that we wanted it to, but B, if Australia goes into a recession, one of the best ways to get out of that recession is to reduce interest rates. Lowering interest rates, as we've talked about before, means that people have less cost to fund their debts, which means that there's more free cash in the system, which fuels individual purchases, it fuels businesses, and it keeps the economy moving successfully. The concern here is that we are now down at 1%, which means that we do not have many more rate cuts available. During the global financial crisis, we very, very quickly reduced rates by 4% in order to free up cash and keep the economy moving. And that was one of the key things that actually stopped us from going into recession along with the US economy during that time. Now, the problem that we face here is that most of the studies have indicated that for Australia to get out of a recession, we normally need about 3% rate cut in order to reverse that effect and move us out of that space. We don't have a 3% rate cut available because we've only got 1% left. Now, 3% rate cut, rates are typically cut at 0.25% increments, so that would be 12 increments. So I often think about it like bullets in the chamber. Ideally, if you're going to go into recession, you really want to have 12 bullets in the chamber. If you're going to go into war, or economic war, you want 12 bullets. The concern is that if the US does have a recession and it has a big impact on Australia, we're going into this economic war with 4 bullets, which bluntly is not enough. Now, there are other measures that we can take. This isn't the only way to stimulate the economy, but none of those measures really are ideal. They're things that you try to avoid as a government. So again, this is another situation where, in some respects, from an investment perspective, we are a little bit on tenterhooks. We do want to make sure that we get calls for all of our clients right, particularly when we're taking a long-term view to how we invest your money. So this is another thing for us where it's not just a case of how will this impact the US, it's also, there's perhaps a higher likelihood it will impact Australia because we don't necessarily have the mechanisms available to be able to avoid the same recession using the same measures that we did earlier. So there you have it, guys. If there's anything that you would like to clarify, of course, I'd really encourage that you please get in touch with me. You're more than welcome to send me an email. Alternatively, if you I'd say click on, but if you type this link into your URL, you'll have the opportunity to book in a time to have a quick chat with me if there's anything that you would like to discuss. As always, I welcome your comments and your thoughts, but to rest assured, this is something we're following very, very closely. We take this very seriously, and if there's anything that we need to do for your own portfolios in the short to medium term, you can rest assured that we'll be in touch with you. Thank you very much, and I hope you have a fantastic Friday.